Assalamu alaikum, everyone. Good morning. Thank you for joining us today for the third session of AlNukhba Program. We are pleased to continue and see your engagement and commitment as we move to another important topic today, which we will be covering financial reporting. Today's session is delivered by Deloitte, which is one of the global leading professional services firm. We have three speakers with us here today. Mr. Walid Slim, who is a partner at Deloitte. Walid has over 30 years of professional experience across the Middle East and the United States. He specializes in financial services, regulatory compliance, IFRS advisory, and he has led major audits across banking, insurance, investment, and other industries. We have with us also today Mr. Vivek Abraham, who is an analytics director at Deloitte. Vivek specializes in technology risk, data analytics, and process automation. He is a chartered accountant and a certified information system auditor and has extensive experience in helping clients manage technology-related risks through advanced analytics solutions. We also have Mr. Uzair Mohamed, who is a senior manager at Deloitte. Uzair has over 12 years of audit and advisory experience in Qatar and Pakistan. He focuses on complex IFRS technical matters and financial services audits, with additional expertise across real estate, construction, manufacturing, and retail. Before we begin, just to remind everyone that your mics have been muted. So if you have any questions, you can write it in the Q&A section, or I can unmute you and you feel free to ask any question. Walid, Vivek, Mohamed, the floor is all yours.
Thank you very much, Sulaiman. Good morning, everyone. Yusat Sabahkum. Today's presentation, we will make it quick and short. Inshallah, we will try to finish it before an hour. And then we'll leave the last 5 to 10 minutes for any interaction, questions that you have or inquiries. So the content of the material will be covering the following. So enhancing the quality of financial statements, the topic will be covered. Next topic will be ensuring compliance with QFMA guidelines through a robust financial reporting closing process. Then we move on to a quarterly investor reporting capabilities. Then we touch on review and update of accounting policies against latest IFRS best practices. And then we cover recent updates on IFRS landscape. And then we talk about optimizing finance team composition, expertise, and skills. And last and not least, we will talk a little bit about the AI and generative AI and where is that in the domain of finance and reporting. So enhancing the quality of financial statements. So high-quality financial statements are essential for transparency, investor confidence, and regulatory compliance. So many organizations struggle with gaps in reporting practices. We are going to touch a little bit about what those gaps are with some examples, etc. And then later, how to address those by bringing the best reporting to the market authority. The first important gap or issue that could be addressed is incomplete disclosures. So as you know, incomplete disclosures can mislead stakeholders. Stakeholders meaning whoever is interested to monitor the share of your company or to buy and sell of those shares. An example could be here, a company might fail to disclose potential legal liability that could impact future financial performance. Second important point as well to address is inaccuracies. So errors in financial data from manual mistakes to incorrect accounting principles could lead to inaccuracies in the financial statements. Take, for example, incorrect valuation of inventory leading to distorted cost of goods sold and also to a net bottom line figure of the financial statements. Lack of clarity. Example is to use unclear or complex jargons by preparing the financial statements. So take, for example, using overly technical language without adequate explanation can confuse non-financial stakeholders, because remember, not all stakeholders have a background of accounting or financial statements. So it has to be very much to the level of any stakeholder user of the financial statements in order to understand, for them to understand it. Inconsistent application of accounting policies. So when you apply inconsistently accounting policies, this is also can cause misrepresentation of actual business performance. Example, changing depreciation methods frequently can distort profit figures of the financial statements. Next is omission of relevant information. So omitting significant events or transactions can result in incomplete financial analysis and misinformed decisions. Example, not reporting a major acquisition or divestiture that significant impacts the company's financial position could have an impact over your financial performance. Last but not least, non-compliance with the regulatory standard. Non-compliance with accounting standard and regulation can lead to penalties and loss of credibility and confidence as well. Example, restatement and fines for failing to adhere to IFRS or GAAP standards. Next, please, Uzair. So the below are the benchmarking techniques the management can focus on having a robust financial statement process across the entity, which is comparing with industry leaders. So, for example, reviewing the financial statements or financial reports next to top performing companies. Second one, using model financial statements, and this is where you can reach out to the Big Four. I don't want to mention only Deloitte. Big Four, they do have model financial statements that you can at least uplift your financial reporting to the best standards. Third is peer review and external audit. So this is where you can reach out to an external audit to review and provide feedback on your financial reporting practices. Now, below are the advantages and benefits of comparing and using model financial statements to the company financial reporting. This is the benefits that you can generate when you compare your financial reporting or your financial statements to the model financial statements that could be taken or could be the help from the Big Four. Standardization and consistency. So uniform reporting, comparability, etc. Enhanced disclosure, comprehensive information, transparency. Next, regulatory compliance, which is adherence to the standard, reduce risk of penalties, etc. Efficiency and time saving. This is where you have a streamlined processes, focus on analysis, etc., etc. And best practices, because when you compare to model financial statements, technically speaking, you benchmark your financial reports and your financial statements to the best of the best. I will give the floor now to Uzair to move to the next topic, which is the QFMA guidelines and regulation. Thank you, Uzair.
Thank you, Walid. Good morning, everyone. The next topic that we will discuss is compliance with the applicable guidelines, specifically on robust financial reporting process. So it is essential for any company that falls under the purview of QFMA to have a robust financial reporting process in place, which includes all transactions that are recorded, are supported and backed by proper evidence and supporting documentation. There are regular account reconciliations in place on, say, a monthly basis, with adequate reviews being performed by a reviewer, and any deviations or differences are reconciled on a timely basis. This will help the company ensure any adjustments that are identified, any corrections that are noted as part of the close process are adjusted in the financial records on a timely basis, and the records are in order. The process of review and approval will ensure that the records remain updated, reliable, and accurate for all stakeholders, internal and external stakeholders, for the purpose of informed decision-making purposes. In addition, it is essential, that financial statement preparation process is solid and in place to ensure a clean set of version is prepared that complies with IFRS and then QFMA requirements as well, which will also help the companies in their external audit process when the auditors opine on the financial information. Disclosure and reporting is critical for companies complying with QFMA guidelines. This will ensure that the companies meet the regulatory requirements expected of the company, and that the management is able to discharge their obligation in terms of disclosures to the stakeholders. Below are some of the factors that we consider, helps the organization achieve their financial reporting milestones. So if you have a robust financial reporting process in place, you will have accurate and timely financial information, which will help in decision making. The company will adhere to regulatory compliance. The financial health can be tracked and will help build trust and credibility with stakeholders. In addition, any risks that are identified can be mitigated, such as risk of errors, frauds, omissions, and those can be timely corrected and rectified by management. It is essential for any company to have a robust financial reporting close process, especially if the company is going forward to its journey for listing. On the next slide, we have some of the critical QFMA reporting requirements. So any company that is that falls under the purview of the QFMA requirement listed on the stock exchange will have to issue an annual report, which will include the financial statements and also have auditor's opinion attached or annexed to it, along with all the information that is relevant for investors' decision making. In addition, a company that is listed will also have reporting obligations on a quarterly basis, i.e., the company will have to submit interim condensed financial information to the users, which will help them stay up to date with the developments, identify any major transactions during the quarter, and help users build trust and credibility over a period of time. In addition, when a company is listed on the exchange, it has requirements to adhere to corporate governance and ICFR reporting guidelines as issued by the QFMA. And it's important that all the companies that are listed comply with those requirements, as the auditors will also opine on both the corporate governance standards and the internal controls of financial reporting framework. So and QFMA has established a robust framework and identified list of auditors who can perform the duties of auditors. So there's a defined list of approved auditors who can only engage in external audit activities of a company listed on the market. And its importance, to investors is obviously it develops trust and credibility that the company is complying with the requirements that the regulator has set out, and ensures, reliable and accurate reporting to stakeholders for decision making, both internal and external. Some of the challenges that any company could face in implementing a strong and robust financial reporting close process could be resource constraints, which could hinder companies' ability to report on a timely basis and ensure adequate reviews are in place. The regulations could be complex, so navigating through the challenging regulation is also something which could potentially create issues. And a must requirement obviously is to have reliable data and information in place. So accuracy of data is a challenge that potentially a management could face, especially if it's very early in the journey towards this listing process. In addition, it's imperative that the companies invest in technology to ensure there is a robust technology systems capabilities in place to streamline the financial reporting processes. In addition, the finance team and across all technical and functional departments, it's critical that qualified professionals are hired by the management, and and they are capable of discharging their professional obligations and have the right skill sets and experience to do so. So these are some of the challenges that a company could potentially face in compliance with QFMA guidelines. and it's early. It's good to spot them early and address them and resolve these on a timely basis to ensure smooth journey and clear communication with the regulator on a timely basis as well. So in the recent times, some of the recent laws that were introduced by QFMA, I would not go into the details of the individual laws, but I will mention some that were recently promulgated. Share buyback regulations was one of them. Market conduct rules, establishment of corporate governance standards. Again, not fairly new, but yes, one of the key laws that were enacted by QFMA. Interim dividend distribution, against one of the recent ones that has come into picture and is an important one as well. These are recent regulatory developments that were introduced by the regulator to ensure the regulator's commitment to maintaining a robust and transparent financial system. And obviously it protects the investor and their confidence as well, and ensures they have the right and accurate, reliable information to make the informed decisions. The next topic that we will discuss is quarterly investor reporting capabilities. So as we said earlier, a company that is listed on the market has a reporting obligation on a quarterly basis to the stock exchange in terms of ensuring the interim financial information for the quarter is out in the market for the users to make decisions. This helps build investors' confidence. They are able to track progress throughout the quarter and also are able to assess if there's any major transaction or any major progress that has happened across the 3-month period. It also ensures that transparency is in place in operational activities when they review and read the investor-related information, and also regulatory compliance as well. So it's important that companies who are listed on the main market have capabilities in place to be able to report and discharge their reporting obligations on a quarterly basis. I think there are a lot of factors that, as we discussed, having the right system in place, resources in place, qualified professional and skill set and experience in place, and a streamlined process of financial reporting to be able to deliver what is required under QFMA laws. An additional important topic that we are going to discuss is review and update of accounting policies against latest IFRS best practices. So IFRS has been evolving throughout the years with the recent updates on IFRS 9, IFRS 16, IFRS 15, and then we are expecting a new standard that will go live on 1st January 2027, which will be IFRS 18, which will change the presentation of the financial statements. We'll talk in the later stage of the presentation. We have a specific section on that. Since the landscape continues to evolve on IFRS front, it is imperative that the company's management are able to ensure that their documentations, i.e. the accounting policies and procedures, reflect the latest IFRS requirements, so that company is also able to adhere to the latest requirements, ensure the accuracy and reliability of financial reporting, and that there are no departures from the required IFRS practices. There are two angles to this. Number one, it's to ensure that the documentation of accounting policies is reflecting of the latest updates, and the practice that is being made is also in compliance with the recent IFRS updates. There could be different practices that management could apply, and there are certain areas where there is accounting policy choice, which could be something that management elects to consider. However, it should ensure that the recent standards are being applied to prepare and form the basis of the financial statement, which will then be audited by the external auditors. The benefits that this will bring to the companies include standardization and consistency. And obviously, once the management prepares financial statement based on the latest IFRS requirements, it will ensure the financials are comparable with what other peers in the industry are doing. It will bring uniformity. It will also allow the users of the financial statements to compare two different entities, since both entities would apply IFRS that are latest and enacted as of a particular period end or reporting year end. In addition, it will help maintain comprehensive documentation of accounting policies and procedures for future reference and compliance. And once management applies the latest IFRS, all of its daily control activities, which are essential to their financial reporting, will be aligned automatically once the documentation with respect to procedures is updated and management adheres to that. So it helps strengthen the internal controls at the company, and which in turn will ensure the financial reporting is accurate and reliable. Further, I think regular reviews and updates of accounting policies are critical. We recommend that on an yearly basis, management reviews their documentation of accounting policies and ensure it benchmarks it with the latest IFRS and identify any deviation and ensure those are fixed on a timely basis. And this will also help that clear and transparent communication is made with the stakeholders, which will again allow them to take informed decision on the basis of the financial information that they will review and read as a reference. So some of the recent standards that have been enacted, and I will talk briefly on IFRS 18, which goes live, and it's essential that management ensures they are ready and prepared for application of this new standard, which will change how your financial statements will look like from January 1, 2027. So in 2026, an initial application impact will have to be disclosed in the financial statement. So it's crucial that a readiness assessment is performed for IFRS 18 related standard, and I will touch base now on what has changed and what are key fundamental changes in the IFRS 18. So one of the fundamental changes that we will see is change in the structure of profit and loss. In addition, we will have a new term, management defined performance measures, and there will be a disclosure in the notes to the financial statements on management defined performance measures, along with the reconciliation of those KPIs with the KPIs as recommended or specified in respective IFRSs. In addition, there is aggregation and disaggregation rules that have been introduced. This standard is effective from 1st January 2027. However, early adoption is permitted, so companies can basically adopt the new standard immediately if they wish to. The objective of this standard was to ensure the companies communicate their the financial information with a specific focus on information about financial performance in the statement of profit loss, and be helpful for user to take accurate decision on the basis of the financial statement that they read. On the next slide is the skeleton of how the profit and loss will look like and how it is currently. So on the left, you will see you have profit and loss applying IFRS 1, which is the standard. We all have been following this practice for some time. And then on IFRS 18, you will see three different categories: operating, investing, and financing. So the profit and loss now would be structured under these three different categories. So it will turn into looking like something similar to cash flow. So this is a key change that we will see in excuse me, once
It's okay, I'll take over, Uzair. So the major change in this structure is that with the new structure or the new presentation of the statement of profit and loss, as Uzair said, your P&L will look pretty much in structure similar to the structure of your cash flow, meaning you will have your statement of profit or loss presenting operating activities, then investing activities, and then financing activities. And the standard is pretty much guiding on what needs to be classified into operating, financing, and investing. And the reason behind this change is stakeholders wanted to have uh, back, and this standard, in fact, has been in progress of being updated for more than 10 years now. So it started when stakeholders approached the standard setters, the OSP, and then requested that they needed a presentation that they could compare companies from an operation perspective across the board. And this is how the standard has been structured, built up, and now in action. In action, it means the standard will be applied effective 1/1/2027. And by the way, in Q1 2026, you need to ensure that you have a disclosure that will show what would be your P&L looking like in case the standard has been applied. And so when the standard is fully applied in 2027, you need to ensure that your 2026 is restated for comparative reason. Uzair, carry on, please, if you want to say something.
Thank you, Walid. Yeah, I think it's essential that companies will start looking at their chart of accounts and reconfigure their mapping to ensure the information that is required under IFRS 18 is available to be reported to the users of the financial statements. In addition, if there are any system upgrades or technological enhancement that needs to be done to ensure the system is there to report the financial information that is required, that needs to be assessed. So, and a comprehensive assessment needs to be performed in details to ensure the financial information is available, is of the right quality and accuracy to be able to report the revised requirements under IFRS 18. In addition, I'll quickly introduce to all of us what is the MPM. So Management Defined Performance Measures is a subtotal of income and expenses that a company uses in public communication outside financial statements. So for instance, a public media release or a disclosure in annual report. So these are some measures that company uses to communicate to to the investors, management's view of how they look at the financial performance of the company as a whole. And these are some of the measures that are not specified or required by IFRS accounting standards. So something, and we will discuss the example as well. One of the examples could be adjusted operating profit. Now, adjusted operating profit could be operating profit considered for instance, a one-off transaction, or adjusted by any major restructuring that has happened during the year, or any major revenue transaction has occurred during the year. So all of these, are factored into the adjusted operating profit to reflect the trend of financial performance, which is essential. But again, it is not the operating profit that we see. So this is, and we'll see the example as well. So one of the key changes that we will see in the financial statements, and we will have a comprehensive disclosure in the notes to the financial statements to define all these management defined performance measures, which are communicated externally to public, stated in the annual report or other communication, for instance, press media release or other forms of communication. What this does is basically gives users or the investor insight into how management is looking into measure the financial performance of the company. So it's becoming essential, and it gives an inside view of how chief decision makers are looking at the financial performance, and driving the investor towards the same view, aligning both the investor and the management.
Anyway, not to confuse
Yeah.
it too much. The standard is guiding with regard to what could be considered as a management performance measures, and then what could be not. So technically speaking, we don't want to elaborate further on that. However, just to give you a flavor of what is a major standard change is coming up, and this standard change, which is the IFRS 18, is going to impact big time all the companies' statement of profit or loss, and with certain disclosures on management defined performance measures that now needs to be taken into consideration, added to the disclosure notes of the financial statements. It's a big exercise. As Uzair said, it's an exercise that will touch on your system, it will touch on your chart of account, and therefore on how the chart of account classification resonates to the financial statement preparation. So it's a big impact and something that we wanted to touch base on quickly here. Definitely we can be reach out later on further discussion with that. Thank you, Uzair.
Thanks. Yeah. On screen, we have an illustrative example as well. I will not go into much details of this as I've already touched base. So a reconciliation on the left can be seen on adjusted operated profit towards operated profit. Now, under IFRS, there is nothing called adjusted operating profit. However, the company could be in their external reporting, in annual report, or in communication to public outside, would be reporting an adjusted operating profit. Adjusted operating profit could include an unusual income and expense that has happened during a particular accounting period, or any adjustment to revenue, or a major acquisition that has led to a jump in a particular income or expense. So all of these extraordinary items will be reflected in adjusted operating profit, which is important to convey, to the users the trend of the financial performance over the period. However, the standard says do a small reconciliation to operating profit to the adjusted operating profit to ensure now the operating profit, which complies with IFRS requirements, will be presented on the P&L as well, is reconciled in notes to the disclosure. So this is just one example. There could be other MDPMs which management could communicate to outside world, and those need to be disclosed and reconciled with IFRS related items in the financial statements. So this is a massive change that we will see in the financials starting January 1, 2027. And as Walid said, we are happy to assist in ensuring management readiness on compliance with IFRS 18 requirements, and we can be reached out at a later stage if management needs our support. We're happy to do so. The next topic is around having a right skill set in finance team. Obviously, with evolving landscape, we are looking at ever so changing requirements on IFRS front, regulatory updates. So it's essential that a qualified and experienced team is part of the finance function at management level in different departments and functions. It will ensure leadership is in place, appropriate financial planning is being carried out, will also help stakeholder communication of financial performance and the strategy that management has laid out. Further, it will aid Chief Financial Officer in making the right decisions. So it's important, the CFO is fed with quality information and data and reliable financial information as well to be able to take decisions that will take a company forward. So having a right finance team around the CFO is crucial to ensure appropriate decision making, which aligns with the company's objective or mission, is in order.
Thank you, sir. Thank you,
Yeah,
sir. Let me just summarize it here and wrap it up before we move to the next topic of AI. So technically speaking, this journey of transformation from a company, from a WLL into a listed company on the main market, a major pillar that needs to transform as well is the finance team transformation. So this whole slide, we don't want to go to the details much, but it brings into summary the importance of today, equally important of having a chief accountant is to have a financial analyst and to have a CFO. A chief accountant who's ready to transform to a CFO, that is great. This is where the capability of the CFO has to demonstrate leadership on strategic leadership and direction of a finance team, and him overseeing planning, budgeting, forecasting, having proper communication with the market authority, with the stakeholders, investors, shareholders, board, etc. So the skill set of a today chief accountant at a WLL entity has to be transformed, whether himself transforming or a new recruit of a chief financial officer that will be able to bridge the communication between the different stakeholders, whether the board, whether the CEO, whether his team members, financial analyst, chief accountant, etc., different departments, chief of marketing, chief of risk, etc., the investors. So a whole mindset of full transformation needs to be taken into consideration. Thank you, Uzair, for your time. I think now
Thank you.
we need to move to the next topic, the AI. Vivek, please, the floor is yours.
Thank you, Walid. Thank you, Uzair. Good morning, everybody. Thank you for your attention so far. I believe it's been an evidently information-packed session. The final topic before we move on to Q&A is on AI. And frankly, no presentation is complete these days without bringing up AI. So at this point in time, I think we can all acknowledge that AI, especially generative AI, has emerged as a complete and transformative technology with the potential to revolutionize not only the industry as we see it, but jobs and, if I may say, life itself. And today we'd like to spend a little bit of time talking about AI advancements and its impact on financial reporting. So let's remind ourselves quickly of some basics. Everybody already understands what AI is, so I'm not going to get into that. But what I would like to point out is AI is not a new technology. So I'll repeat that: AI is not a new technology. In fact, it's been around since the 1950s, and AI use cases has been pretty dominant and widespread in many industries, especially in financial services and maybe a little bit more recently in digital marketing. But what has exploded in the recent past is generative AI, which is the ability to use the fundamental principles of AI in predictive modeling and machine learning to create new content, new text, new images, music, videos, 3D models, and before you know it, we might even be using generative AI in the recent future to generate financial statements. So the examples of AI, of generative AI, are of course ChatGPT, which caused this revolution, or sort of started with it, and we are all aware of what that is. And similar language models like Gemini and image rendering models like DALL-E. So coming back to our context, which is finance and finance transformation and finance roles, let's take some examples of how AI is transforming some of the finance roles. So the first example I'd like to talk about is around the use of AI for cognitive automation. So we're all aware of what automation is, which is largely rule-based. So we can think of that like if X, then Y, right? So we define these rules based on which the automation is programmed. This is helpful, and it has been helpful for many years, but it is also limiting. Cognitive automation goes several steps further, and it introduces machine learning to the mix, and which means you do not always have to have predefined rules. So an application of this is where decision making can also be automated, right? So decision is not a decision that has been decided before and it's being reapplied. A new decision can be automated through cognitive automation, which AI powers you to do. So this naturally helps improve the efficiency, and I mean, improve is the wrong word. I would say it exponentially improves efficiency. Another way that we see is the way that we are engaging numeric data that as finance professionals we often deal with through through text, through natural language. So imagine being able to chat in a chat GPT like format and make inquiries of numeric data that is that your AI platform is plugged in, without having to work on Excel or work on Power BI or even interact with your ERP. Forecasting is another domain where we are seeing more increasing adoption within finance, where more complex forecasting is being enabled through AI. So to talk about some specific examples and use cases, Uzair, if you can move on to the next slide, we'll see how some of the roles that we are familiarized with, right, within the finance functions are reimagined, or how these roles are in fact leveraging some of the applications in AI. So if we start with an AP clerk or an accounts payable clerk, you can see examples where AI is being used to scan hundreds of invoices, incoming vendor invoices. It's being used to understand which vendor these are coming from. Mind you, these are in different formats, understanding context, being able to accurately extract the right information and post these into the ERPs, all without having absolutely no human intervention. Right. This is quite extensively used now in finance shared service centers, and these mechanisms are getting smarter and smarter and able to be more efficient and accurate in the way that it's being used. Q&A chatbots, I briefly mentioned this earlier, the ability to use a secure, and I underline the word secure, ChatGPT-like portal to ask questions of internal policies, your own specific white papers, accounting white papers, published standards, and even your own financial data. If we move on to the role of a finance controller, we see the application of cognitive automation in how reconciliations are now being performed and largely automated. So cognitive automation, like I said, is the ability to make decisions, and in some cases, it's the ability to recognize why a certain reconciliation needs to be performed a certain way, and even in the use of variance analysis, where it's not just important that you are that it's able to automate the computation of the variance, budget versus actual, but come up with what is a suggested root cause of that variance, and it might be basing that on historic data, or it might be basing that on what is common in the industry, and maybe any other type of factors. Moving on to the CFO role, we're seeing use cases in real-time reporting. So this is again real-time insights into financial performance, which was a dream for most CFOs, and this is becoming a reality with the use of AI tools. And one of the avenues, or one of the ways that this is made possible is through dynamic forecasting, is the ability to use the predictive modeling and forecasting capabilities of AI to continuously analyze data and update forecasts in real time, providing more accurate way of reporting and real-time reporting, as we like to call it. So just to wrap up, how do us as finance professionals stay relevant? And on the bottom of the slide, you can see a couple of pointers. And I'd say staying relevant means staying informed, being updated with, what is AI being used for? Where are its applications? How are the applications being modeled into our specific industries? What specific tools are coming in? How are our existing platforms and tools being enhanced in the use of AI? And how do we get to start using them? Or how do I enable our organizations to start using them? Another way is to be aware that there is a constant learning involved, and means we keep having to learn new things. And I'm not asking people, roll up their sleeves and learn how to code, but being able to learn skills that AI will continue to struggle with, right? Which is, empathy, stakeholder management, creative thinking, and in some cases decision making, but contextual decision making, not sort of structural decision making. And lastly, it's the mindset. So we have to see and we have to embrace that kind of mindset where we are not pushing AI away because we are afraid of what it might do and how it might take over certain aspects of our day-to-day roles. It's clear that it is there. It is a tool that we must use to help ourselves and to help our organization. So in conclusion, AI and Gen AI, they're not just sort of buzzwords. They are transformational tools, and that can very well have applications in the reporting landscape. And by staying informed as finance professionals, we can definitely leverage this to our benefit and to our organization's benefit. Thank you.
Thank you, Vivek. Thank you, Vivek. Let me, sorry, I just need a few minutes. I want to bring in what this AI, Gen AI that Vivek mentioned into reality so that we all, finance people, understand it better. I'm going to give an example, take you through step by step what could be changes and the impact of the AI, how it would be helping all of us. So take, for example, VAT introduction. Suppose VAT is introduced on 1/1/2026. We know very well, before us as finance people, we need to ensure that amendment, adjustment to the chart of account are taken into consideration so that we understand very well what needs to be added as accounts into your chart of account. And the proper linkage to the financial reporting is also taken into consideration, meaning VAT receivable, VAT by liability, etc., etc. Now, and together with an impact on the P&L statement, where is the VAT appearing on the P&L, whether it appears, doesn't appear, depending on what could be not claimed, etc. So I'm not talking much about the VAT impact here. I just want to take into consideration what could be impacting me and how can I use technology to help me. Suppose we link all these things together, and then we have a small assumption here that, by the way, people income was not changing following the change in the VAT. Meaning, if I was earning 1,000, I'm still earning 1,000 regardless of the introduction of VAT. Now, the company, if it has a great historical information and data well cleaned, they can go back in time and do an analysis in order to find out, with the introduction of this VAT, an assumption that people income did not change, what could be the what could be the impact of the company on its revenue? Meaning, we know very well the introduction of VAT is going to impact the end users, right? If an end user income did not appreciate with the introduction of VAT, maybe there is a linkage of his spending. So technically speaking, by us assuming or adding all these factors into the system, the Gen AI can help us understand what could be the impact of the P&L, of the revenue of the entity in the future in case of VAT is introduced, or 5%, 10%, 15%, etc., etc. This is the possible usage of the Gen AI, because we are generating artificial intelligence, we are generating future possibilities in case things are introduced from a different authority perspective. I just wanted to give this flavor in order for all of us to understand what could be AI or Gen AI used meaningful to all of us as finance team. Thank you very much, and I'm very much happy to take any question that you gentlemen have.
Thank you, Walid, Mohamed, Vivek. So we have a couple of questions that, so I'll just go through them. Any favored or recommendable software in terms of being compliant, especially for the AI capabilities and FinOps and also FP&As?
If you allow me, Vivek, and then I'll leave the floor to you definitely. Definitely, we can give some views on the systems, but it would be much better, Sulaiman, to have a project to understand the complexity of the entity, the current system that is used as the entity, the industry of that entity, and then accordingly bring in the best system in order to help best the team generate best AI, Gen AI of that system. Vivek?
Yeah, that's, I was going to say the same thing, Walid, but I also want to sort of point out, I think that question came in a while ago, so it might be, for one of the earlier topics. Maybe we can just get clarified what is the context of the compliant aspect, whether it was IFRS 18, I'm not too sure.
So until we get an answer on that, I'll just move on to the other question. Does the MPMs include the ESG disclosure?
Yeah. So thank you, Sulaiman. So ESG is covered now under IFRS S1 and S2. So those are separate disclosures that are required to be reported in the financial statements altogether. However, if there is any specific ESG related performance matrix which can be quantified and is communicated in the annual report, say, or other communications, for that as well, a reconciliation will be required to be provided in the financial information. It depends on the matrix itself, and if it relates to remember the subtotal of income and expenses. That's the key definition of management defined performance measure. So if any of the impact with respect to ESG comes into the P&L, the related cost and the income, if there is any, and any related KPI related to that subtotal of income and expenses reported to external stakeholders, then a reconciliation will definitely need to be given. It depends how management is reporting.
Just to add to what Uzair is saying, in fact, Sulaiman, there is a very much prescriptive guidance of the IFRS 18 standard that helps you assess what could be considered as a reportable MDM and what could not be one considered. There is a proper roadmap that you follow in order to assess what this qualifies or doesn't qualify. بكل صراحة.
Okay. I actually had a question. So you mentioned that QFMA has a list of approved auditors, which if you want to come to the Qatar Stock Exchange, you have to engage with them. So usually, when does a company start the process? Yeah, in terms of timeline.
Yeah. So definitely, this is the experience that we have seen, and this is the recommendation that we have definitely considered and heard. In the journey to be listed, it would be advised that a company considers right when they start the journey to appoint a approved auditor of the list that is of QFMA. And the reason, because say the journey is 1 year, at least through that journey, a approved auditor is already appointed, and that auditor will ensure that he is, the moment that is approved, meaning the company will take the requirement the requirement of the QFMA to have a approved auditor right on the listing day and before that listing day, because technically speaking, it will be considered as a showstopper in case the journey was from an auditor who's not approved by the QFMA to get the company to the listing. I'm not sure if I addressed your questions, Lemon.
No, perfectly. So you have to start it as soon as you decide, or you have the intention to go public.
100%.
Well, thank you so much, gentlemen. Thank you, Walid. Thank you, Vivek. Thank you, Uzair. May I just remind everyone that the recording will be available, and I've just posted a quick survey. If you could please spare a few moments to go through it, that will help us improve the course. Thank you, everyone, and have a great day.
Thank you so much.
Thank
Thank
you.
you very much. Thank you.